In this video, we're going to be breaking down futures contracts, but in order to break down futures contracts, we need to start with what is a forward contract, and then we can get into the differences between the two of them. I've got a definition listed here, and this definition will apply to both forward contracts and futures contracts. So let's go over it. A forward contract or a futures contract is an agreement between two parties to buy or sell an asset at a certain time in the future. The key here is that this all happens in the future for a certain price. And let's just go over this with an example that I've laid out below. Let's say you and I, we both trade in the oil market. We trade barrels of oil. And let's say you're interested in purchasing a barrel of oil 1 month from now, and I'm interested in selling a barrel of oil 1 month from now. This is just an exchange over the counter between the two of us, and there's no standardized exchange that we're going through. It's just a handshake agreement between me and you. So what we could do is we could look at the price of a barrel of oil and how it's changed, let's say from January to June. We can see it's bouncing around quite a bit. And then we can agree on a price to sell, let's say on July 1st. So we're going to say today here is June 1st. And then let's say we might think the price is going to go up a little bit. We're going to lock in some price appreciation. And the price right now is at like 35. And so we agree to lock in a price of about $40. So you're saying 1 month from today, you're going to buy a barrel of oil from me for $40, and there's no way to get out of this. This is a legally binding agreement. And then we can say over time that this price, let's say it goes up like this. Then the difference between your payoff and mine is going to be exactly offset. So the price went up to, let's say, $50 here. We agreed to sell it at $40. You're going to have a $10 gain on this contract because you're able to buy something for $40 that's actually worth $50. And this, what we locked into between June and July, we would call this actually a 1 month futures contract. So a 1 month futures contract. However, let's say we go back and we're interested actually in an exchange that's 2 months in the future. So instead of trading in July, we want to trade on August 1st. We could actually set a price out this far. So let's say we say $40 a barrel on August 1st. And then the price goes like this over time. And it's actually now worth, let's say, $20. You still are required to pay me $20, or you're required to pay me $40 for an asset that's only worth $20. So my payoff from that contract is actually a $20 profit, whereas you lost exactly what I gained because it's a zero-sum game. Now let's walk through how would a futures contract differ from the forward contract. There are 7 key differences between forward contracts and futures contracts. I've listed all 7 in this red text over here on the left side of the screen. And then I put the details for each of these 7 categories for the forward contract in this black text here, and then this blue text here for futures contracts. Now let's just go one by one and talk about them. So the first category is standardization. So the forward contract is not standardized. It was a handshake agreement that the two of us made for that price of oil. If you think back to the last example, we just did that over the counter. We came up with our terms ourselves and we made a contract and we traded. That was not standardized. However, if we wanted to get a 1 month price in the future with a futures contract rather than a forward contract, it would be standardized through an exchange. Now, a good example of a popular exchange is actually CME Group. And so I'm going to hop over to their website real quick to show you what I mean. So on the CME Group's website, we can see that there's crude oil, and it's trading with futures contracts. And we can see that it's standardized at a certain price. There's a amount of volume that's being traded. We can see the change over day in price. And so this is a lot like if you ever traded stocks on the stock market. Now let's jump back over here and look at the second category, which is settlement. So the forward contract is actually settled at the end of the contract. So when we gave that example previously, we were looking at what if the price had decreased $20 below the settlement price that we agreed to? Well, at the end, you would have owed me $20 in that scenario. Whereas with the futures contract, we would have settled on a daily basis through our accounts in the exchange. So every single day, however much it deviated, we would settle up, and whatever I owe you, I would pay you at the end of the day. Whatever you owe me, you would pay me at the end of the day. And that would actually make sure that we're receiving that value sooner or losing that value sooner. Now, another category that's different is credit risk. So when we made that handshake agreement with the forward contract to trade a barrel of oil, you would have been exposed to me as a counterparty, and I would have been exposed to you. What would have happened in that month if, let's say, something bad happened where you couldn't pay me what you owed me, or vice versa? I couldn't have paid you what I owed you. Then we'd have to go to court and do some sort of legal battle or something like that. So we're both exposed to each other as a credit risk. Whereas with the futures contract, there's virtually no credit risk because we're trading through the exchange. So really the only way that we don't get paid is if the exchange fails, which is super unlikely because it's a huge financial institution that would probably get a government bailout, etc., if it ever couldn't make payments. So if I couldn't settle up in my account, then the exchange would have to pay out my portion to you. And so really your counterparty exposure would be with the exchange, which is a super credible source. The next category is the size of the contract, right? So the forward contract is completely customizable. In the example I gave on the previous screen when we did a forward contract, we just had 1 barrel of oil. But let's say we wanted 5,587 barrels. We could have decided that that would be the number of barrels underlying that contract. However, with the futures contract, there are standard sizes. So let me jump back over to the CME Group's website. And if I scroll down a little bit, we'll see explore this product in depth. And so this is the contract details. The size of this contract is 1,000 barrels. So no matter what we want, we can't do 5,587. We have to do it on 1,000 barrels. So that is actually one sort of advantage for the forward contract, is that you can get the exact size that you want and it's completely customizable. So the fifth key difference of a forward contract and a futures contract is delivery. With the forward contract, usually there is a delivery of physical goods. So if we think back to our first example, we made that handshake agreement. At the end of the first month or the second month, however long we agreed to, I would have physically sent you that 1 barrel of oil, and you would have sent me cash for that oil. So that would have been a delivery of physical goods. However, with futures contracts, they're usually settled in cash on the exchange. Rarely are the goods actually exchanged at the end of the deal. It's just each day we settle, cash is exchanged, and then one day we might just decide to close out that position. Either one of us could close out that position separately by taking an offsetting futures contract with a different party entirely. Now, one key difference is the regulation. So with the forward contract, there's very little regulation. Think back to that initial example. Me and you found each other, we shook hands, we decided to exchange a barrel of oil at a certain price a month from today. That's not very heavily regulated. I guess we could have had a contract that specified the price, but that's between the two of us, and if it's violated, then we might have to go to court together, etc. However, with the futures contract, this is extremely heavily regulated because it's a massive exchange and a massive financial institution that has their own risk management department, their own auditors, their own government entities that are regulating them heavily. So all of this is heavily regulated. And with regulation comes additional costs. So you could almost potentially look at this as a pro for the forward contract. There's less cost associated with less regulation, so there's less of a middleman fee that the exchange has to charge to keep up with all this heavy regulation, etc. But also you are a bit more protected because of how heavily regulated it is, so there's pros and cons to both. The final key difference between forward contracts and futures contracts is liquidity. So with the forward contract, it's extremely difficult to find trade partners. So once you've entered into a trade futures contract, it's going to be hard to trade out of it by finding a separate third party to take your end of the deal, for example. However, with futures contracts, it's very easy to trade and find trade partners. We can see that by just jumping over to the CME Group's website. And if we go over to quotes, we'll see that, so right now it's August of 2023 for me. So this contract right here would be 1 month in the future. So this would be a 1 month futures contract on crude oil. And we can see that there's a volume of 296,000. So there's already been 296,000 trades of this. So it should be extremely easy for me to trade out of this contract should I want to, or enter into a new contract. So it's an extremely liquid contract, most of these futures, due to them being traded on an exchange like a stock exchange.